This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Bitcoin, blockchain, ICOs, Ethereum, and all the rest. Are cryptocurrencies the 21st century unicorn, a speculative bubble, or the future of money? The CryptoCast will help you understand the rise, the fall of digital currency, the highs, the highlights, the potential, and the lows, the scams, and pitfalls. I'm your host, Jason Hartman, and we'll talk with some of the biggest names in the space. CryptoCast is your resource for all things crypto. Let's go. It is my pleasure to welcome Joseph Wang to the show. He is the author of Central Banking 101, and he spent 5 years studying the plumbing of our financial system as a senior trader for the open market desk at the Federal Reserve. Yes, the Federal Reserve does have a trading desk, and Joseph was there. He's going to talk to us all about the mortgage market, mortgage-backed securities, how they're traded, the Fed's former involvement in them, and just about the Fed and the economy in general, of course. Prior to joining the desk, as he calls it, Joseph was a credit analyst in another life and practiced law. I guess we could say he's a recovering lawyer, huh? He holds a BA in economics from Northwestern University and a Juris Doctorate from Columbia Law School and an MSc in financial economics from Oxford University. Joseph, you have got more degrees than a thermometer. Welcome. How are you?
Thanks so much. Thanks for inviting me, Jason. It's a pleasure to be here.
It's great to have you. And it was really a pleasure hanging out with you. We had a speaking engagement in Houston together, and it was a pleasure sharing the stage with you. And I got to tell you, I just really enjoyed your presentation there and have wanted to get you on the show ever since. So I'm glad you're here. People are concerned about interest rates right now. They have risen quite dramatically. The Fed has ended their purchasing program of mortgage-backed securities, right?
That's right. And you know what? They might even sell some mortgage-backed securities in the future. So they are definitely doing a 180 from what they used to do.
So tell us about that. How much did they do? When did it start? When did it end? If you know these details, and how much impact does that have on the mortgage market? And, we really almost have to divide it into two things, Joseph. The availability of mortgages, but also, of course, the cost of mortgages, the interest rate on mortgages. But a lot of people sort of gloss over availability in general because interest rates or cost and availability aren't always in sync like some might think they are.
That's a really good point. So there's a couple ways to think about that, just separate from the interest rates perspective. As we know from the GFC, back during the GFC, anyone can get a mortgage, right? Availability was very wide. And post-GFC, credit availability was much tighter. Now, that has to do with the regulatory powers of the Fed and the government more generally. So post-GFC, the authorities became much more stringent on allowing credit. So even though you can see, say, a 2.5 mortgage rate outside, as you noted, it's not available to anyone. So credit availability post-GFC has definitely shrunk, and that's part of a design by the authorities to try to rein in the excesses of the pre-GFC world. Banks, for example, are subject to much stringent regulations, so they don't really want to have as much risk as they used to be able to. So that's one part that the Fed and the authorities more generally affect the mortgage market. The other one is directly from the Fed, and that's about interest rates, as you noted. So the Fed has a tremendous influence in setting mortgage rates. And so if you remember, just last year we were having, a couple years ago, we had mortgage rates of about 2.5%. A lot of that is because what the Fed was doing. And I'm thinking we probably will never see mortgage rates that low again.
Yeah, so they engaged in a program of buying these mortgage-backed securities, and that really fueled the market of credit availability, right?
So they did two things. One, they did quantitative easing for buying mortgages, like you mentioned, but they also did quantitative easing and bought treasuries. And just to give you a scale of this, like over the past couple of years, the Fed probably basically bought about almost $5 trillion in total of these treasuries and agency MBS. Now, these affect mortgage rates in two ways. The first, when they buy treasuries, they're lowering the treasury yield, right? And the second, when they buy mortgages, they're lowering mortgage rates directly. Now, these are a little bit different because so when you get a mortgage, the lender is basically going to quote you something based on the spread of where the 10-year treasury is. So let's say the spread is, let's say, 2% above 10-year treasuries.
Yeah.
Okay. So if the 10-year treasury is 1%, then you add 2%, you get 3%. But if the 10-year treasury goes down to 50 basis points, then 2% plus 50 basis points, you get 2.5 mortgage. So when the Fed goes out and it buys trillions, and I mean trillions of dollars of treasuries, they're putting downward pressure on the 10-year treasury. And that means mortgage products, which trade as a spread to treasuries, also get lower together. So that's the first part of what the Fed's quantitative easing is doing. The second part is much more direct. They're going out and buying mortgages directly. And what that does is lowering the spread, narrowing the spread between mortgages and treasuries. So if you think back to that example I was just talking to you about, after buying trillions of dollars in agency MBS, maybe the spread is not 50, maybe the spread is not 200 basis points. Maybe it's 150, maybe it's 100 basis points. So that also makes mortgage rates go lower. So over the past 2 years, the Fed has done QE to basically an unprecedented level. And that's in a largely responsible to the very, very low mortgage rates we saw, just post-COVID until, let's say, a few months ago. And you can kind of see that really obviously. So a few months ago, when the Fed was basically hinting to the market that it's going to stop buying, mortgage rates shifted higher. What happened first was the spread. So the spread between agency mortgages and the 10-year widened significantly. So that's the Fed walking away from the market, getting ready for the Fed to walk away. So that's one thing. And I think going forward, the Fed is actually going to be doing quantitative tightening. So that's going to push the 10-year higher, in my view. So mortgage rates are probably have further to go on the upside, I think.
How much farther?
Oh, that's a really, really good question.
That's the $1 trillion question. How much farther up will they go? You're saying they're going to go up.
Yeah.
A lot of people agree with you, by the way. How much higher?
So, if you're a mortgage investor, another thing you have to keep in mind is inflation is probably going to be high as well, though. So, right. So even though the rates go higher, your rent that you receive, it might be going higher as well, because the real rates, for example, might be low.
I mean, and by the way, let's just expand on that for a moment, if we may. But remember what you were going to say, please. Right now, if the stated rate of inflation is 8.5%, and the official rate of inflation, and you're welcome to disagree with me on this, but I think it's about 15, 16, maybe 17% even. Of course, it depends who you are, how you spend, et cetera. And we're all different in that way. But call it 15% for round numbers' sake. You're getting paid to borrow. You're still borrowing significantly below the rate of real inflation and, interestingly, official inflation, which is very rare that actually happens, where you can borrow below the rate of official inflation, the CPI rate. And it would just seem kind of simplistically logical to me, and I think it does to other people too, that if you want to curtail inflation, you've got to raise the borrowing rate above the inflation rate, right? Maybe by about 2% or so. So that means that rates would be 10.5%. Wow.
Whoa, no.
That would be really bad. It's not going to be that bad, right?
I don't think it'll be that bad.
Okay.
But I think
we got some good news.
But the upside is if you're in like residential real estate, for example, you always have that option to refi, right? So one day, someday, maybe if the rates drop, you can always have that option to refi. So I mean, you kind of hedge that risk a little bit. So it's not necessarily a bad thing to do mortgages in case you're afraid that rates might go down.
Sure. And the rental income is indexed to the mortgage rate and the housing price rate ultimately, but it takes a few years to adjust, right? It catches up slowly, about 2, maybe even 3 years. So that's why investors right now, they kind of look at things and they think, wow, this deal doesn't pencil as well as it used to. And they're right, but they've got to look at what's coming in the future, maybe higher mortgage rates and certainly higher rents, I believe. But what do you think?
I think we're going into an inflationary world. And so that's part of the reason why I think mortgage rates will go higher. But as you mentioned, rents will also go higher as well. So I think the way that I would look at this, it probably depend on a case by case basis. And in some places, once we go higher more, higher mortgages also affect house prices. So you have to weigh that as well, right? On the one hand, maybe if you wait 5 years, you have a higher mortgage rate, but also prices will be lower. So it's not easy to say whether I should buy now or later. So I'll leave that up to the experts like yourself.
No, definitely. I mean, higher mortgage rates push prices down. They put downward pressure on prices, but they put upward pressure on rents. Still, though, inventory is so low. It's increasing, but it's going to take a while, I think, to increase a lot to get to even normal levels, but that's another discussion. So
I remember your talk in Houston, you mentioned that because everyone has such low mortgages, people just be hoarding these mortgages and they won't sell. And that's like the first time I've ever heard anyone mention that. And I think that's going to be spot on. People are just going to hoard those houses, they won't sell. That's going to have a big effect on supply, on inventory going forward. I mean, I know that I have a 2.5% mortgage and I'm never going to sell this place.
I agree with you. I mean, if you need to move for some reason, you just keep that as a rental, your house in Las Vegas, because why would you ever want to sell that mortgage asset? I mean, it'd just be crazy to sell that. And that really was kind of a poison pill that the Fed put into the real estate market that is going to exacerbate the housing shortage for a long, long time, I think.
Yeah, I agree. Stuff like this, it's the Fed actually, they try to do the best, but there's just so many things happening in the economy. It's a lot of moving parts. They're not going to get it right all the time. So I think that, like you mentioned, a lot of people believe that you're going to have to raise interest rates to above inflation to curtail it. Certainly people like Larry Summers have been motioning for higher interest rates. And I think that's probably how they're going to go. But the good thing is that the mortgage rates are linked to longer term interest rates. And what the Fed does is they raise shorter term interest rates.
Right.
Now, longer term interest rates are going to have more to do with things like, say, supply and demand of treasuries and things like inflation. Going forward, what you'll notice is that, we have forever deficits, right? So the government just spends and spends. And how does it pay for it? It just issues treasury debt. And treasuries rate is like any other product. You sell a lot, then prices are going to go lower. And when you sell a lot of debt, that means higher yields. So, I would expect rates to go higher, probably secularly from now on. So on the second point, when you come to inflation, I actually have a couple cool slides that I think that'll be helpful in your audience in understanding why I think that, inflation might be secular. But
so for those of you listening to audio only on the podcast, we'll try and explain the slides, but of course you can see them on YouTube.
So I think one of the things that you would think, so this is something that I'll acknowledge that it's not fully conventional, but makes sense to me. So as you know, we're entering into a world where the population is aging. The baby boomers are retiring, right? And I think a lot of people look at this and they think that, we have more old people, we're going to have low growth and low inflation. That's possible, but there's another way to look at this, in that when you have more older people, what you're really doing is you're decreasing the supply of labor in the world. And when you decrease the supply of labor, wages go higher. And, obviously that's inflationary. So on a micro level, everyone both consumes and they both produce, right? If you're like a boomer, you're producing a lot. You have a lot of work experience. You're adding that into the economy. Once you retire, you're not doing that anymore. You're not producing anymore. So what you're doing is you're just consuming every day. So basically supply decreases and demand increases a little bit more, but supply, if you're retired, goes to zero, demand is still there. And what we're seeing right now in the US, and I do this for a broad range of countries. So what you're doing in the US is you're basically, the amount of retired people is going to increase, so the supply of labor is going to decrease. Now, this isn't just happening in the US and in Europe, but it's happening worldwide. And that's really important because over the past few decades, the big phenomenon that's happening in the world is that you had tremendous amounts increase in labor from countries like China and the other middle income countries. Because of global trade, basically hundreds of millions of people entered into the labor force and they pushed labor prices lower.
Right.
Now in the US, we know that the baby boomers are retiring, but what people don't actually acknowledge though is that this is happening even in the middle income world, especially in a place like China. So in this graph here, so I'll highlight in yellow, you see that during the 1975 to basically now, we had an increase in population from 25 to 65, basically prime working age population. That population increased from, looks like it's 600 million to 1.4 billion. So almost a billion people came into the global labor market, right? And because we have globalization, we benefited directly from the increase in labor. So
Sure.
when you see the Chinese manufacturing, we're all importing basically their labor. Now, what's changing now is that their population in China and the rest of the middle income countries has also plateaued. So if you look to where we are now in 2020, their working age population is no longer increasing. It's plateauing, and that has to do a large part with like the one-child policy in the past.
Yeah.
So the second thing is that you notice is that their population is rapidly aging. They're kind of like us now.
China is the fastest aging country in the entire world, even worse than Japan now.
Exactly. So, you have a tremendous decrease in the supply of labor globally, and that's going to push up wages, and that's going to has enormous amounts of implication. I think it's probably really good if you have, let's say, rental real estate, because if people have higher wages, they can pay more and rental income. But it has a lot of other implications on a macro level when it comes to interest rates. If this is true, and then we have a secularly declining labor pool, wages rising secularly, then inflation is going to be secularly higher. You can think of it like a wage price spiral that we saw in the 70s and 80s. So the central banks are going to look at that, and they're going to try to fight against that. And the way they do that is they're going to continue to increase interest rates. And so when you ask me how high I think interest rates will go, I think they secularly trend higher over the coming years. Now we'll have pullbacks because we'll have financial panics when people go and push rates lower, but I think the trend is higher. So
that's what I was going to say, Joseph. The only real solution to this future of high rates is another crisis, right? You need another big recession. You need another COVID. You need some or another war. And I won't call it an excuse. I'll just call it a justification for them to artificially lower rates again, right?
We could definitely do that. Yeah.
Do you think the Fed, I'm really quite critical of them now. I think they let the economy run hot for way too long when COVID was, essentially over, or at least the lockdown phase was. And everybody was out buying houses and spending stimmy checks. The economy was essentially booming in a way, right? And people were moving all over the country. They should have raised rates more gradually back then. They just waited too long to act. And I just really wonder if Powell really thought it was transitory, as he kept saying, the inflation rate. But
I think it's probably one of the biggest policy mistakes they've made in quite some time.
I agree.
So I used to work at the Fed, and I can tell you that the Fed it's a very left-leaning organization. It's not surprising. It's government, right? So that thinking, in my experience, I think filters through into policy. So there's a very good article from the Wall Street Journal, Michael Derby at the Wall Street Journal, and he looked at political donations made by Fed people, and they basically overwhelmingly to the Democratic Party. And if you recall what happened last year, so the White House was going on telling everyone it's transitory. Why? Because they really wanted to pass their huge social spending bill, right? So those were the talking points. And I think that filters into the Fed staff thinking, and which in turn influences what Powell does. So Powell probably was convinced by his staff. But the thing is, ultimately there's a political basis for them thinking that way, and that filtered into policy and partially resulted in the huge inflation we're seeing right now. And I think it continues to influence dialogue, because if you listen to what people are saying now, they're like, we can't raise rates because that'll cause some unemployment, and that's really, really bad, and we have to avoid that at all costs. But that's a trade-off to fighting inflation, and if you're not willing to make it, if those are your politics, then we're going to have inflation continue, because without some kind of recession, higher unemployment, it's really hard to see this inflation going away.
Well, that's the old Phillips curve debate, right? What do they do? But frankly, we could afford higher unemployment. maybe more easily than we can afford much more inflation. And I'm just speaking as, most people, right? How
Yeah.
most people are affected, the broad population. But, one interesting component of it is government debt. The government owes a lot of money and likes to keep spending. So when you look at government debt, aren't they digging their own grave in a way by making their own debt service much more expensive?
So you're exactly right. But the crazy thing is government doesn't really care about that because they have a magic money printer, right?
Right, right.
So,
They have
so
MMT.
they
Yeah,
no, that's exactly that actually is how the government operates. You just look at COVID, right? So they
right,
spent a couple $1 trillion, and where did the money come from? They just printed it. Now,
right.
there's something special about the US Treasury market that I'm not sure most people are aware of, and that is when you think about it, treasuries are kind of like a form of money. So you have $100 bill, it's printed by the US government, right? But if you have $100 in treasuries, it's also printed by the US government. It's also very liquid. You could sell it instantly and it actually pays interest. So, in a way, from a very high level, treasuries are basically a form of money. This is actually how a lot of institutional investors think, because if you have $1 billion, you can't put it on deposit at a bank. The bank might go bust. What you do is you hold it in treasuries. So, government debt is a form of money. So, when you see massive deficits, that's just them paying by printing money. So public debt is really not a problem. The problem is inflation. If you print a lot of money and you go and you buy goods and services like what they did in 2020, you're going to get inflation. It's just common sense. And the trajectory seems to be that we'll just continue doing this. In the future, we're going to have to do more of it because we have to pay for things like Medicare, Social Security. It looks like we're going to have to pay for free college too. So
Yeah, right,
yeah.
right. And bailing out Social Security too. It's interesting to hear the sort of, I'll call them old school kind of conservative thinkers when it comes to monetary and fiscal policy that keep talking about how bad the debt is. And I've been hearing that since the people that sort of grew out of the 70s, like Howard Ruff. I don't even know if you know that name, but they've all been talking about the doom and gloom of the debt, right? The government debt. And the reality is, none of them, not Peter Schiff, not any of them, none of them know how much debt a country that has the reserve currency of the world can afford to have. Maybe the debt to GDP ratio can be 2,000%. I don't know. Nobody does, right? We've never been here before. Is there an answer to that? Everybody keep predicting all this collapse, dollar collapse, and I just think they're just wrong, wrong, wrong. And they've been wrong, wrong, wrong so far, but they sure do get a lot of press.
They've been
I guess
so wrong.
maybe I'm just envious of all the press they get, and I don't get it. But yeah,
You can start saying it too.
yeah.
So I think the problem is that people misunderstand how we've moved from a gold standard to a fiat standard since the 1970s. So when you're on the gold standard, you actually can't have too much debt and you can default because you don't have any gold. So then you can actually have like a serious calamity like they're mentioning. But what they get wrong is that we're not on a gold standard anymore. And so a lot of economic theory and monetary theory has to be reinterpreted in that light. When you have the magic printer, then you can never default. So default is never a problem. You can carry debt infinitely because you can just print to pay it. The problem always has to be inflation. And eventually we're going to get to a point where that becomes a serious problem. Actually, we're probably already there. So the policies that you'd have to be careful looking forward to is higher interest rates. We see that already, and that's easy to see because the Fed is fast at acting. But the second part, what you have to be mindful of is higher taxes, because that's the second tool in taming inflation. Now, Congress is disorganized, so we won't get that for right away, but eventually that's going to be part of the toolkit. So I think that's what everyone should be mindful of as well.
Right, but the argument by those people that keep arguing that this inevitable collapse is coming is that other countries will stop buying our debt. And when they do, we're over. It's over. And they will stop believing in the dollar and stop using it as the reserve currency. What do you say to that? Those two things.
Well, if they don't buy it, the Fed will buy all of it. And the Fed has been buying a lot of it the past 2 months. So that seems to work out just fine. So I think it's helpful to understand why other countries have been buying dollars. So the way that the global trade works is that it's actually on a dollar-based system. So if you're Japan and you're importing or exporting something from to Korea or something like that, you are actually paying in dollars and receiving in dollars for what you sell. So everyone holds the dollars in the world because the dollar is the currency of global trade. Right. Now, if you are a foreigner and you're in global trade, you have dollars and you just kind of have to put it somewhere. So people put it in treasuries as a safe place to put dollars. It's not because they have confidence in the US, it's simply because it's kind of like a network effect. It's like MasterCard or Visa. Everyone runs on dollars.
Well, and what's interesting, just to add to that, and no one really knows the number here, but so do actual people, just private citizens in these other countries. They store their wealth in dollars too, many times, quite literally under their mattress, many of them. They all want dollars because they don't trust their own currency, whether it be Argentina certainly is a great example or whatever, right? A lot of them store whatever dollars they can get a hold of as well.
Exactly. There's actually a study by the Fed about currency in the US. This may be surprising, but the most printed currency is actually in the form just of $100 bills. And you rarely see a $100 bill on the street, right? It's like a 10 or 20. And the estimate is that most of those $100 bills are held abroad and probably either in the cartel or by, let's say, people in Argentina or other countries escaping high inflation. So it does play a role as a store of value for private citizens, like you mentioned.
Yep. And I bet a lot of Turkish people are doing that too. Anyway, just to finish on, what do you say to those two things? Number one is the argument is they'll revolt against the dollar as the currency of trade, as the reserve currency. They'll just stop doing it. And there certainly is some nibbling around the edges, right? Especially with the Russia fiasco. Now there's some trading outside of the dollar, right? Global trade, but it's so minor. I mean, what do you think? Is that a real threat to the dollar?
I don't think it's a real threat. I think there's a trend going forward that there will be people trying to build alternative arrangements outside the dollar. And the reason being, as you mentioned, the Russian fiasco, the West basically confiscated the money held by the Russian sovereign bank, central bank. And a lot of countries, if you're China, if you're Russia, if you're India, you don't want people to just take your money. That's a national security issue. So they're going to find a way to get out of this dilemma. It's going to be very hard. But if you're worrying about the collapse of the dollar, I wouldn't really worry about it collapsing against other currencies. I would worry about it collapsing against goods and services, which is to say inflation. So we could have high inflation and, people could still use the dollar. Strange as it may sound, it's happening right now. So I don't really worry about the dollar collapsing anytime. Throughout history, there are always regime changes in global trade. Before the dollar, there was the British pound, and before that, it was, the Netherlands. Eventually, it's going to shift as well. That happens over a long time period. So.
Yeah, I agree with you. I couldn't agree more. I think the dollar is going to last for a very long time, but nothing lasts forever.
Nothing lasts forever.
Does it surprise you, and I don't know, Joseph, if you follow the cryptocurrency market at all, but I'm certain at the very least you've read the headlines. Does it surprise you that crypto has just had a bloodbath? I mean, we have inflation. Isn't this supposed to be the hedge against inflation? And isn't gold supposed to be the hedge against inflation? And gold does almost nothing. Like why not?
That's a really good question. Well,
any thoughts?
For crypto, it's obvious, right? I always thought the use case for crypto primarily was that it made the people who got in first rich. Other than that, it's hard to see too much of a use case. That doesn't surprise me. I think many people look at that and think about the dot-com bust, and it looks like they were right so far. It does seem like there's a huge implosion there. For gold, though, I think the difference is that we have a generational shift in what money is. If you think back a generation ago, for a long time, we were on the gold standard. Gold was money. So when you see inflation, you instinctively grab for gold. I'm not sure the newer generation thinks of the world the same way. So if you're looking for a hedge for inflation, it's probably going to be the things that will, first of all, real assets, obviously, but the things that are in need. So energy, for example, commodities, let's say aluminum, green metals, you want to bet on policy mistakes, and policy mistakes are in part responsible for our inflation. That's underinvestment in fossil fuels and the idea to double down on green. So if you were worried about inflation, I would buy fossil fuels and green metals. But things like gold and cryptocurrencies, they haven't worked in the past couple of years when we had tremendous inflation. So it seems like that's just not how the world works, even though in theory it could plausibly make sense.
Yeah, all right. Talk to us, Joseph, about the Fed itself. And I don't know how much you can say. Obviously, it's your former employer, but we've certainly done many, many shows about the conspiracy theories. G. Edward Griffin has been on several times. I'm sure you know his famous book, The Creature from Jekyll Island. I actually, a few years ago, took my mastermind group to Jekyll Island, and we had our meeting, our retreat there. Our meeting was in the Federal Reserve room.
Oh, that's awesome.
Yeah, I was just wanted to get a history lesson there. And by the way, that's a beautiful place, Jekyll Island, Georgia. What don't people know about the Fed that you're able to share with us? You know, the shadow banking world, just anything.
I think the number one mistake people make about the Fed is just misunderstanding their competence and their intentions. So, there is no grand conspiracy, no man behind the curtain. The Fed it's much more, it's kind of like the post office, right? It's just public government. And the people there, they're just, it's like post office employees trying to do the best. Maybe they don't know what the best is, just doing their best job. So I would expect the Fed to continue to make policy mistakes simply because, it's just a public organization trying to do the best it can. And it's actually quite simple. They try to be as transparent as possible. There's no grand conspiracy. There's no alternate intentions. They make an effort to be open, and I just think they're trying to do a good job, but they don't. Just not very good at it.
Yeah. Well, that's really quite interesting that you say that, and you compare to the post office. I mean, most of us think of Jerome Powell and the Open Market Committee as, these have got to be the smartest guys in the room, right? As the saying goes by the Enron movie. There's a movie called that about Enron. These are the people that essentially run the global economy almost. I mean, they have more influence than any other central bank. Wow. Really, it's just mere mortals, huh?
That's what makes them so dangerous, right? They have so much power. It wasn't like this beforehand. There was a time in the past where our world was not so financialized and the Fed was not so concentrated. 100 years ago, actually, the central bank in DC, the Fed in DC, had very little power. Everything was run out of the New York Federal Reserve Bank of New York. They basically called the shots, but that's all different now. It's super centralized in DC, tremendous power because the world is so financialized. So when they make an error like they did last year, it affects all of us significantly. Again, when they did a good job like they did during March 2020 and saved the financial markets, that helped everyone. But when you make a mistake, it also affects everyone. So that's the risk with concentrated power.
Yeah. Do you agree with what they did during the COVID time? Like, was that intervention, was that justified? I mean, some real libertarian people believe they just shouldn't have done anything. Let the market work itself out, or during the Great Recession or the global financial crisis, whatever you want to call it. Was that right of the Fed to get involved and stimulate the economy and act like Keynesians? Or should they have just kind of let the economy take its medicine and it'll pass,
I think the way I think about this is just to look at the history of the Fed. Institutions exist for a reason. Now, when there was no Fed, what we would often see is that we would have banking panics. So a bunch of people would go to a bank, ask for their money back, and the bank, they had the money, but just not at the moment, right? It's a basic liquidity problem. And so the people would panic, they would withdraw their money, the bank would get in serious problems because they had to fire sell assets, then they would have solvency problems. So the Fed came into being to prevent those panics. People are emotional. Sometimes they get scared. And if you are able to provide, let's say, emergency liquidity, that calms the panics and everything goes back to normal. So that's how the Fed came into being in the past. And that's what they tried to do in March 2020. Emergency liquidity panic throughout the world. There's this weird sickness that we hear about on TV. Everyone's trying to get their money ASAP. So there was a liquidity problem, not just in the banks, but in the shadow banks as well. The Fed stepped in, provided lender of last resort, calmed everyone down, and everything went back to normal. If they didn't do that, then people would have to fire sell assets, take realized losses. There'd be bankruptcies and liquidations. I mean, if you work in real estate, a lot of valuation is actually confidence and sentiment. So stepping in helps it. But their policy error was, as you mentioned earlier, just staying in the market too long. So why were you buying all those mortgage-backed securities when, real estate was going up 20% a year? That doesn't make any sense, right? So they overstayed their welcome, but they did the right thing for being in the market in March 2020. That really saved a lot of damage to the economy.
Yeah, I agree. It should have been a very short-lived thing. And why were they still participating when values are going up 20% a year and, there's massive bidding wars on houses? It was just ridiculous. I know we've got to wrap it up, Joseph, but I just want to ask you about one more thing because you mentioned it a moment ago, the shadow banks. What does that mean?
Great question. So a shadow bank is a group of, let's say, businesses that act like a bank, but are not banks. So when I say act like a bank, what does a bank do? Bank has loans, asset loans on its balance sheet that are due in maybe in 5, 6, 7 years, but it has liabilities that are due immediately, like a deposit, right? So I can go to a bank and ask for my money back whenever I want. So a bank has a business model where they have shorter dated liabilities and longer dated assets. A shadow bank.
And by the way, before you move on, I just want to say to the listeners, remember, a bank looks at it the opposite of how we look at it. We look at a bank account as our asset, but it's their liability. We look at a loan as our liability. They look at it as their asset. So just to understand that, but go ahead on the shadow banks now.
Exactly. And a bank has access to a lot of emergency liquidity tools. For example, if suddenly there's a run on deposits, a lot of people go withdraw money from a bank. The bank can go to the Fed and ask for an emergency loan. So everything is fine. Now, there are a whole lot of other entities that basically have the same business model. For example, you can have, let's say, a mutual fund where you can invest in the mutual fund, and the mutual fund goes, it takes that money and it buys corporate bonds. If you think about it, it's a lot like a bank because the investor can go to that mutual fund and withdraw money anytime it wants. The mutual fund would have to sell the corporate bonds, long-dated assets to get the liquidity. A securities dealer is similar. A securities dealer borrows in the repo market overnight and uses that money to purchase 5-year treasuries. So you have a whole class of investment vehicles who behave with that bank-like structure. The difference being is that they don't have access to the Fed for emergency liquidity. So when something breaks, then they can't go to the Fed for emergency loan. They just have to fire sell assets to meet their liabilities. And sometimes that breaks things because when everyone fire sells, then prices go lower, more people have to fire sell, ends up in a deflationary spiral.
And would you use like long-term capital management as an example of this?
Yeah, absolutely. So long-term capital management funds itself in repo, basically, let's say overnight or 1-week loans, buys a whole bunch of longer dated foreign sovereign bonds. So classic shadow bank.
Yeah, that's a truly amazing story. Listeners and viewers, if you haven't looked up long-term capital management, this was the company that they thought they had the market figured out. Clearly they did not have it figured out.
When Genius Failed was the seminal book on it.
Right, exactly. Any outlook for the future you want to share before you go? You said interest rates look like they're going higher. That's going to bum a lot of people out. But overall, I think it's probably what needs to happen for the economy. Yeah. They need to at least get to the inflation rate, the official rate, to calm inflation and tame inflation. What about the stock market, precious metals, cryptocurrencies, that unemployment rates, the real estate market, whatever you want to share, just any thoughts you have on what's coming?
I'd be cautious with all financial assets. If you think back what happened in March, you had the Fed cutting, but not just the Fed. You had a coordinated central bank easing throughout the entire world,
right?
Japan and Eurozone. So it's pretty easy. So when central banks coordinate throughout the world and they make easy money available and cut interest rates, asset prices go higher. I mean, that's exactly what we saw the past 2 years. Now they're doing the exact opposite. It's not just the Fed that is tightening monetary policy. It's the Canada, England, the European Central Bank. Bank of Japan, not yet, but eventually they'll cave. And when you do that, all asset prices have to come down in value. So that's what I'd be cautious for going forward. And this is basically the intention of policymakers.
Yeah.
Policymakers want people to have a little less money to spend. That's how they control inflation. There's too much demand. If you have everyone suddenly exploding in home equity and their 401ks, they're going to go and buy stuff. and that makes inflation worse. They're trying to reverse all of that. So you want to be very cautious if you're in any financial asset going forward.
Yeah. If you're in stocks right now, would you be selling your stocks?
So I own lots of oil and gas producing commodities, and I sell like tech and things like that. So that's what I do. I feel like there's going to be good areas in the market where it continue to grow based on the policy areas that the world is on in energy. But other than those, I don't hold any other stocks.
Yeah. Okay. So energy is...
I like energy a lot. Yeah.
Okay. Yeah. Interesting. Very good. Well, Joseph, give out your website. By the way, if you really want to take a deep dive into this stuff, folks, Joseph has an academic book entitled Central Banking 101, and it's in all the usual places. Of course, on Amazon, it has 261 reviews, which is pretty amazing for an academic book like that. Yeah.
Well, I try to make it more accessible. So if you're interested in my work, Central Banking 101 on Amazon.com, as Jason mentioned. I can also be found on Twitter, FedGuy12. And if you're more interested in a more in-depth dive on timely market topics, check out my website, FedGuy.com.
Excellent. Joseph Wang, thank you so much for joining us.
Thanks for inviting me, Jason. It was a pleasure.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.